Everyone wants investing to feel smart, strategic, and a little bit exciting. There's this idea that if you're not constantly analyzing charts, tracking earnings, and jumping on opportunities, then you're somehow falling behind. But the truth is, complexity is often just disguised insecurity. It gives the illusion of control, when in reality, it usually leads to worse decisions, higher costs, and more stress. Simplicity, on the other hand, doesn't feel impressive at first. It feels almost too easy, and that's exactly why most people overlook it, even though it consistently outperforms over the long run. When you simplify your investing approach, you remove unnecessary decisions, and every decision you eliminate is one less chance to make a mistake. Think about how many times people buy into hype, sell out of fear, or try to time the market based on emotions. These mistakes don't happen because people are unintelligent. They happen because complexity creates too many moving parts. The more choices you have, the more likely you are to act on impulse rather than logic. A simple portfolio removes that temptation. Instead of asking yourself what to buy next, you already know. Instead of wondering when to sell, you don't. Instead of reacting to every headline, you stay focused on a long-term plan. And that clarity is powerful because it turns investing from an emotional activity into a mechanical one. You're no longer trying to win every day. You're positioning yourself to win over decades. There's also a hidden cost to complexity that most people underestimate, and that's fees. The more complicated your portfolio becomes, the more likely you are to invest in funds or strategies with higher expenses. These costs might seem small in the moment, maybe 1% here or 0.5% there, but over time, they compound against you. Instead of your money growing at its full potential, a portion of it is constantly being siphoned away. Simplicity naturally leans toward low-cost index funds, and that alone can make a massive difference in your final outcome. Another issue with complexity is that it often relies on prediction. Complex strategies usually involve trying to identify trends, forecast market movements, or pick winning sectors. And while that sounds logical, the reality is that markets are incredibly efficient. Prices already reflect the collective knowledge of millions of participants. Trying to outguess that consistently is extremely difficult, even for professionals. A simple approach accepts this reality. It doesn't try to predict the future, it participates in it. When you invest in a broad, simple portfolio, you're essentially saying that you trust the overall growth of businesses, innovation, and the global economy. You're not betting on a single outcome, you're betting on progress itself. And historically, that has been one of the most reliable bets you can make. Economies expand, companies evolve, technology improves, and over time, value is created. A simple strategy captures that without needing to know exactly where it will come from. There's also a psychological advantage that doesn't get talked about enough. Simple portfolios are easier to stick with, and consistency is far more important than perfection. You could have the best strategy on paper, but if it's so complex that you abandon it during a downturn, it doesn't matter. A simple approach is easier to understand, easier to trust, and easier to maintain when markets get volatile. And volatility is guaranteed. At some point, markets will drop, headlines will turn negative, and fear will take over. In those moments, complexity becomes a liability. It makes you second-guess everything. Simplicity gives you something to hold on to. Another benefit is time. Complex investing requires constant attention. You need to monitor positions, rebalance frequently, stay updated on news, and adjust your strategy. That's time you could be spending elsewhere, building your income, developing skills, or simply enjoying your life. A simple portfolio frees you from that. It doesn't demand daily involvement. It runs in the background, quietly doing its job while you focus on things that have a higher impact on your overall financial picture. And here's the part that surprises most people. Simple strategies often outperform complex ones, not because they're more sophisticated, but because they avoid the common pitfalls that drag returns down. Overtrading, high fees, poor timing, emotional decisions, these are the things that hurt performance. A simple approach minimizes all of them. It's not about maximizing gains in the short term, it's about preserving gains and compounding them over time. There's also a tendency to equate complexity with intelligence. People think that if something is simple, it must be basic or inferior. But in investing, simplicity requires discipline. It means resisting the urge to chase trends, ignore noise, and stick to a plan even when it feels boring. That's not easy. It goes against human nature. We're wired to seek excitement and react to changes. A simple strategy forces you to do the opposite. It asks you to stay calm, stay consistent, and trust the process. In a world where information is constant and opinions are everywhere, simplicity acts as a filter. It protects you from overconsumption and overreaction. You don't need to know everything. You don't need to act on every piece of news. You just need a solid foundation and the discipline to maintain it. That's what turns investing into a reliable system instead of a guessing game. And when you zoom out, that's really what long-term investing is about. It's not about being right all the time. It's about creating a framework that works even when you're wrong. A simple portfolio does that by spreading risk, reducing costs, and eliminating unnecessary decisions. It's designed to succeed not because it predicts the future perfectly, but because it doesn't depend on prediction at all. Most beginners think diversification just means owning a few different stocks. Maybe they buy a tech company, a bank, and something in energy and assume they're protected. But real diversification goes much deeper than that. It's not about how many investments you own, it's about how different those investments truly are from each other. And that's where the combination of total market, international, and bonds becomes incredibly powerful because it spreads your risk across different economies, industries, and asset classes all at once. When you invest in a total market index fund, you're not just buying a handful of companies, you're buying thousands. Large companies, small companies, fast-growing businesses, stable dividend payers, all bundled together. Instead of relying on a single company to perform well, you're relying on the collective performance of an entire economy. And historically, economies grow over time. Companies innovate, expand, and generate profits. By owning the entire market, you automatically capture that growth without needing to guess where it will come from. But even that level of diversification has a limitation. It's still tied to one country. And no matter how strong that country's economy might be, it's never guaranteed to outperform forever. There are periods when certain regions dominate and others lag behind. That's why adding international exposure is so important. It allows you to participate in growth happening outside your home country, in different markets that may be at completely different stages of development. International investing isn't just about chasing higher returns. It's about reducing dependence on a single system. Different countries have different economic cycles, political environments, and industries. When one region faces challenges, another might be thriving. By spreading your investments globally, you create a balance that helps smooth out volatility over time. You're no longer tied to the success or failure of one economy. You're aligned with global progress as a whole. There's also a currency component that most people overlook. When you invest internationally, you're indirectly holding different currencies. This can act as an additional layer of diversification. If your home currency weakens, your international investments may gain value when converted back. It's another way to reduce risk without needing to actively manage it. Then there's the third piece of the portfolio, and this is where things shift from growth to stability. Bonds are often misunderstood, especially by younger investors who see them as slow or unnecessary. But their role isn't to outperform stocks. Their role is to protect your portfolio when stocks become unpredictable. Markets move in cycles, and there will be times when stock prices drop significantly. During those periods, bonds tend to be more stable, sometimes even increasing in value as investors move towards safer assets. This stability matters more than people realize. When your entire portfolio is in stocks, a market downturn can feel overwhelming. Seeing your investments drop sharply can trigger emotional decisions, like selling at the worst possible time. But when you have bonds in your portfolio, the overall decline is less severe. That cushion makes it easier to stay invested and stick to your plan, which is ultimately what determines your long-term success. Another advantage of bonds is liquidity. They provide a source of funds that can be used during downturns without needing to sell stocks at a loss. This creates flexibility. You can rebalance your portfolio by selling bonds and buying stocks when prices are low, effectively turning market volatility into an opportunity rather than a threat. This is one of the key ways diversification works in your favor, not just by reducing risk, but by giving you options. When you combine these three components, total market, international, and bonds, you're building a portfolio that is designed to handle a wide range of scenarios. If domestic markets perform well, your total market fund drives growth. If international markets outperform, you benefit from that exposure. If stocks struggle, bonds provide stability. Each piece has a role, and together they create a system that doesn't rely on a single outcome. What's interesting is that this approach doesn't try to predict which part will perform best. Instead, it accepts that different assets will lead at different times. There will be years when international stocks outperform domestic ones, and years when bonds outperform stocks. Rather than trying to time these shifts, diversification ensures that you always have some exposure to whatever is working. This also reduces the pressure to be right. You don't need to constantly analyze trends or make adjustments based on short-term performance. The portfolio is already structured to adapt naturally. Over time, as different assets grow at different rates, your allocation will shift slightly, and you can rebalance periodically to maintain your desired proportions. This keeps your risk level consistent without requiring constant attention. Another important aspect is correlation. Not all assets move in the same direction at the same time. Stocks and bonds, for example, often behave differently under certain economic conditions. International markets may react differently than domestic ones to global events. By combining assets with varying correlations, you reduce the overall volatility of your portfolio. The ups and downs become less extreme, making the journey smoother. And that smoother experience is more valuable than it might seem. Investing isn't just about returns, it's about behavior. A portfolio that swings wildly can lead to poor decisions even if its long-term returns are strong. A diversified portfolio, on the other hand, helps you stay consistent. It keeps you invested through different market conditions, which is ultimately what allows compounding to work. There's also a scalability factor. This type of diversification works whether you're investing a small amount or managing a large portfolio. It doesn't require constant adjustments or advanced knowledge. It's simple, repeatable, and effective across different stages of your financial journey. As your investments grow, the same structure continues to support you without needing to be reinvented. And perhaps the most important part is that diversification acknowledges uncertainty. It accepts that you don't know which market will outperform, which economy will grow fastest, or when downturns will happen. Instead of trying to eliminate uncertainty, it builds around it. It creates a portfolio that is resilient, adaptable, and capable of performing under different conditions without relying on perfect decisions. Everyone loves the idea of high returns, but almost no one talks about what actually produces them over time. It's not a single investment, it's not perfect timing, and it's definitely not luck repeated over decades. It comes down to two things that most people overlook because they seem too simple: consistency and cost. These are not exciting concepts, they don't make headlines, and they don't give you instant gratification, but they quietly determine whether your portfolio grows steadily or falls short of its potential. Consistency is what turns investing from a one-time decision into a long-term system. It's the habit of showing up again and again, regardless of what the market is doing. When prices are rising, consistency means you continue investing instead of waiting for a dip that may never come. When prices are falling, consistency means you keep investing even though it feels uncomfortable. This removes the need to predict the market, which is one of the biggest mistakes people make. Instead of trying to time your entries and exits, you rely on a process that works across different conditions. This approach is often referred to as dollar cost averaging, but at its core, it's about discipline. You invest a fixed amount at regular intervals, whether that's weekly, monthly, or whenever you receive income. Over time, this means you buy more shares when prices are low and fewer shares when prices are high. It naturally balances your cost without requiring you to think about it. And more importantly, it keeps you invested, which is the single most important factor in long-term growth. Because the reality is, missing just a few of the best days in the market can significantly reduce your returns. Those best days often come right after the worst days, when fear is at its highest. If you're trying to time the market, there's a high chance you'll be sitting on the sidelines during those critical moments. Consistency eliminates that risk. You're always participating, always positioned to benefit when the market recovers. Then there's the second factor, and this one is even more underestimated: costs. Every investment has some form of cost, whether it's management fees, transaction fees, or hidden expenses within a fund. These costs might look small, but they compound over time just like returns do, except they work against you. A 1% fee might not seem like much in a single year, but over decades, it can reduce your final portfolio by a significant margin. What makes this even more important is that costs are one of the few things you can control. You can't control market returns, you can't control economic conditions, and you can't control short-term volatility. But you can control how much you pay to invest. By choosing low-cost index funds and minimizing unnecessary trading, you keep more of your money working for you instead of losing it to fees. There's also a connection between consistency and cost that people often miss. The more you trade, the higher your costs tend to be. Frequent buying and selling can lead to transaction fees, taxes, and mistakes driven by emotion. A consistent, long-term approach naturally reduces trading activity. You're not constantly adjusting your portfolio or reacting to market movements. You're following a plan which keeps costs low and performance steady. Another important aspect of consistency is that it builds momentum. In the early stages, your contributions make up the majority of your portfolio. But as time goes on, your returns begin to generate their own returns. This is where compounding starts to take over. The longer you stay consistent, the more powerful this effect becomes. Eventually, your portfolio grows not just because of what you're adding, but because of what it's already earned. This is why starting early is so valuable, but it's also why continuing is just as important. Many people start investing with good intentions, but they stop during market downturns or when life gets busy. That interruption breaks the compounding process. Consistency isn't just about starting, it's about continuing through different phases of life and different market environments. There's also a psychological benefit to focusing on consistency and costs instead of returns. It shifts your attention away from things you can't control and toward things you can. Instead of worrying about whether the market will go up or down next week, you focus on whether you're sticking to your plan and keeping your costs low. This creates a sense of control and reduces stress, which makes it easier to stay committed over the long term, and that long-term commitment is what separates successful investors from everyone else. It's not about who picks the best stocks or who times the market perfectly, it's about who stays invested, who avoids unnecessary costs, and who allows compounding to do its work over time. These factors might seem small on their own, but together they create a powerful system for building wealth. Another advantage of low costs is that they improve your margin for error. When your expenses are minimal, more of your returns are retained, which gives you a buffer against periods of lower performance. High costs, on the other hand, create a constant drag on your portfolio. Even if your investments perform well, a portion of those gains is always being taken away. Over time, that difference becomes substantial. Consistency also helps you build confidence. The more you follow your plan, the more you see how it works in practice. You experience market ups and downs, and you realize that staying invested through them is what leads to growth. This reinforces your behavior and makes it easier to continue. It turns investing into a habit rather than a series of decisions, and habits are powerful because they operate automatically. You don't need to constantly motivate yourself or analyze every move. You've already decided what to do, and you simply follow through. This reduces the mental effort required to invest, which increases the likelihood that you'll stick with it over the long term. In a world where people are constantly searching for the next big opportunity, consistency and low costs might seem too simple to matter. But that simplicity is exactly what makes them effective. They remove complexity, reduce mistakes, and allow your portfolio to grow steadily over time without unnecessary interference.